Compared to a year ago, the bond market has significantly changed. In 2023, we were focused on the Fed actions with still aggressive rate hikes. We were looking for spreads, and we were also looking at rising stars. At the end of the day, Fallen Angels delivered a 13.24% return for 2023, making it the 7th best performance calendar year out of the last 20 years. The most exciting opportunities for Fallen Angels in 2024 that we're looking at is carry, quality, and the different sector exposures Fallen Angels offers versus broad high yield. We believe catalysts for further price appreciation from either rates or spreads are somewhat limited. We do expect returns to be driven primarily by carry. We do not necessarily think that long-term yields have much more room to decline based on current economic data. With that said, we believe that some of the return potential that we had anticipated for 2024 was pulled into the last quarter of 2023, and now we believe that the 2024 return may be in line with the current yield. We do expect to see some volatility throughout the year. Performance versus broad high yield will likely be driven by quality and sector differences until we see a material impact from new Fallen Angels. We expect a normalization of rising stars as the reversal of the 2020 downgrade wave appears to be behind us. And we do think that the increase in real estate sector downgrades over the last couple of months of 2023 is notable, and it may continue into 2024. Overall, we think that the real estate sector is not off the hook just yet. Last, we believe that Fallen Angels are poised for positive returns as seen on the chart. Why? Because double Bs tend to outperform single Bs and triple C on lower rated bonds on average over the following 3 months, 6 months, and 1 year periods after the Fed pause. Remember that the Fed paused in July of 2023 and that currently Fallen Angels have about an 80% exposure to double Bs. The main risk going into 2024 that we see for Fallen Angels and in general the bond market is a sharper pivot much earlier than originally expected, which would probably be driven by either an economic shock or some geopolitical events. We believe that it will cause a spread to significantly widen as a recession will be back on center stage. If that were to happen, Fallen Angels could still outperform due to their higher quality and the tailwind of a longer duration. If a recession does in fact happen, it will also increase the chances of new Fallen Angels, which have historically been a driver of outperformance. It happened back in 2016 and back in 2020. With that said, credit migration forecasts are calling for Fallen Angels to outpace rising stars this year, as there's some sign of weakening fundamentals and there's a significant amount of investment grade debt on the edge of high yield.